Hi, everyone. This works? Amazing. So we will be talking about everyone's favorite water cooler topic today, credit downturns. Am I right? We have an amazing panel with us today with, I think, combined over 50 years of experience in credit and banking. And so if they could please join me. I've kind of lost Ardalan up. All right, so as people are trickling in, and before I go into the quick introductions, Alex, could we kind of get the poll going? I feel like it'll take people a little bit of time. So would be great to get kind of everyone's pulse on how they're feeling about the economy right now before jumping in, and it'll also help you kind of wake up after your post-lunch food coma. So the first question will be, what economic credit conditions should we prepare for in the next 6 to 12 months? So there should be a QR code popping up, and if you could just pull out your phones, kind of follow along, that would be great. That was my test earlier, so everyone can ignore that answer. And as those answers are kind of trickling in, let me introduce the panelists. So we have Ardalan here, who is the Chief Risk Officer at FIG Financial, with prior experience at RBC and Capital One. We have Amit, who is the current SVP of Risk Operations at RBC, with prior experience at American Express and Capital One. You'll start to see a trend here in a second. And Brent is the founder of Payson Solution, and with prior experience at Capital One, you guessed it, holding many roles, amongst them Chief Credit Risk Officer. So a lot of credit risk experience here. Our discussion today will cover two main topics. The first one is lessons learned in the 08-09 recession, and then the second one is how fintechs are addressing the current uncertainty in the market. So I'll get to those topics in a second. I see that the answers have trickled in. We'll assume that was everyone. If not, there's a second question so you can kind of get on board. So it seems that we're kind of in the continued correction, pull back at the margin, amongst for the next 6 to 18 months. Oh, yeah, that's really the top vote. Any comments from the panelists? Is this kind of what you had expected? Is this what you're also seeing?
What do you guys think? I think that was my prediction going in. At least that the audience would say that, yeah.
Okay, he'll let you know if that was right later, I guess. All right, Alex, can we switch to the second question? So this one, around expectations for the interest rate. So I think the next announcement is in 3 weeks. I'm sure all of you with variable rate mortgages are kind of eagerly awaiting that announcement. Let's take a look at what you think, and maybe as they kind of trickle in, panelists, what do you think? Ardalan, what's your kind of expectation?
Yeah, I was going to go for later this year as well, Q4, but nobody can hold me to that.
There's consensus growing in the middle, yeah. So I feel like this would have been different had we asked the question a few months ago. Amit, you agree?
I agree. By the way, if I could predict the interest rates, I would not be where I am. But like, it feels like, based on, again, the wisdom of the crowd here, Q4 seems more likely.
Yeah.
RBC controls it, don't you guys? Or?
I wish.
It's a different department, right?
All right, amazing. Thanks everyone for your participation. And Alex, we can switch back to the slides now. We'll jump into that first topic. Yeah, perfect. We have a few stats of the current kind of economy, just to kind of ground everyone on what we're currently seeing. And also now we're going to kind of think about the past a little bit. So although some of us up here may have still been in school at the time of the 08-09 recession, I won't name names, Brent and Amit were very well into their career. And so my question for the two of them is kind of, what did you learn going through that period before, as it was happening, and after? And if you could kind of situate us in your answer before starting. Brent, let's start with you. I believe you may have been rocking some piercings at the time, so things have changed in the last 15 years, but take us back.
All right. Well, Sam, you took my jokes away too. How many people here, hands up, if you were in your career during the Great Recession? Hands up. Okay. So you wouldn't know it by looking at me, but I was well established in my career at that time. You learn a lot going through something like that. And I have two really vivid memories from that time. So one was near the outset. I was working at HSBC, and this was February 2007. And I remember coming into the office, working in Toronto, and there's some people I didn't recognize in there with British accents. And when you work at HSBC and guys show up with British accents unannounced, that's usually not a good sign. So they got us together in the lunchroom and they said, we're going to announce today that we're writing off 1.8 billion in subprime mortgages. We're shutting down the consumer lending business. Half of you are going to lose your jobs and enjoy the free pizza. And so that was at the outset. And then my other vivid memory from the Great Recession was later, September 15th, 2008. Does anybody know what day that was? What happened that day? Michelle? Lehman. That's right. That was the day that Lehman failed. And so then it took it to another level, because as a credit professional, it went from, pulling back on credit to more of an existential crisis. Like, if Lehman's can fail, we can fail, anyone can fail. So really, the stakes were really high. But again, learned a lot going through that. I mean, one thing I learned was when it happens really fast. Like in 2008, things were blowing up in the US, and working for a US company like Capital One, I got to see that firsthand, but things are still relatively good in Canada. We're kind of waiting for the other shoe to drop. And then when it dropped really fast. I think in about 6 months, our losses pretty much doubled. And something I learned there is every recession is a little different, but it doesn't impact every asset class the same often, right? And so what we saw is our prime asset, it's kind of a misunderstood thing in credit. There's absolute loss level, but then there's beta, like how sensitive or how much variance you have, or your loss is going to have to an economic shock. And kind of in a contrarian way, the prime assets, we saw more than doubled in losses, and the subprime assets went up by less than 50%. So I think conventional wisdom's kind of always pull back on your riskiest asset classes, but I think equally important is how are you pricing in your prime and your lower risk assets where you got a lot less pricing margin to play with, right? And then the other big learning was just being prepared to move really fast. So when you heading into a downturn, like I think a lot of us think we are, you want to be the first one to act. And then when you hit that inflection point, you want to be the first one to get back into the market and grab good business. We didn't do that good job of that because we were really dependent on US tech stack. And I think acting faster would have been a lot better. So being ready to act fast and pulling back on new acquisition, I would say, because the new business you book heading into a downturn is always much, much worse than your back book. So I think a lot of lenders spend a lot of time doing credit line decreases in that. I think they would have been a lot better served just pulling back on the acquisition.
Thanks for sharing. Amit, what about you? You were at American Express at the time. I'm guessing no piercings, but you could share if you want.
Sam, thanks for making me feel really ancient. So I was actually at Capital One in the US, and actually switched in March of 2007, maybe a week before Bear Stearns happened, from running a business to running credit. So if any of you want, to have a career, conversation with me, don't come to me for advice. It was a verse, it's good from a learnings point of view, but at that time it was horrible, right? It was I became, as Brent would say, right in the center of the storm at a time, trying to then, beat back the credit storm that was emerging. And similar to what Brent mentioned, the key things is that you cannot predict a downturn ever, but you can, number one, prepare for it. That is probably, the most important thing. You don't start digging a well after the fire has started. You got to, prepare for it. And it's good to see, in the first poll where folks mentioned that, that, hey, let's start working around the edges, sooner rather than later. So that's one. Second piece that Brent mentioned as well was around, again, there's good business to be done in a downturn, especially if you're in retail. I can't speak for capital markets and all, but if you're in retail or small business, even commercial, the reality is some of the best cohorts, that have been most profitable were the ones that were acquired in a downturn when others, exited the market, and there was demand. We could pick and choose what we wanted. So it's very important to stay open for the business. It also gives confidence to clients that you're there for them, that you're not just trying to be with them in good times and leaving them alone in bad times. So that's very, very important. And then the third piece is the decisioning platforms, is to make sure that you've invested in a decisioning platform that can that can help you, move quickly, and especially in, it's maybe a little bit more true for banks than fintechs, but people are very, very quick to cut, but don't have a playbook for the recovery, right? We need a downturn playbook, but we also need a recovery playbook, and that's is something that is definitely something which is very important.
Yeah, amazing. Thank you. So a lot has changed over the last 15 years, and one of those has been the kind of rise and prominence and growth of fintechs. And so Ardalan launched last year. Why don't you take us through kind of how your team is managing this current uncertainty, and maybe just comment on fintechs in general if they're taking a different approach than the banks?
Yeah, thanks, Sam. I was worried you took it easy on me. I was going to say.
I didn't have anything on you. No dirt.
The punch to come. No, but thanks for that. I mean, it's maybe I'll share a couple of thoughts, but maybe the short answer of it is we really try to combine both fin and tech. So fintechs sometimes tend to focus more on one part of it, and in particular tech, which, by the way, is great. We need to focus on customers. It's our compass. We believe in that as well. But for the sake of this conversation and Downturn, it's really about that fin side. And so just this week, actually, there was a couple of stories that really resonated with me that I wanted to share. And that had to be the Berkshire Hathaway general meeting actually happened about a week or so ago. And, if I think about investment space is very similar. There's endless news, positive signals, negative signals, sometimes contradictory, especially if you're trying to predict downturn, they're telling you different things. And so when he was asked, how do you keep up with this? And, obviously being the legendary investor that he is, his answer I found was interesting. Basically saying, Charlie and him got a lot of things wrong, but they didn't worry about the things that they didn't understand that they got wrong. And so I think that's one of the key things, right? So how are we adding that sophistication, that understanding? The team here talked about the data, the principles, the modeling. Sounds like we've got a very sophisticated group here based on the responses. Clearly, you're looking at margins, you're doing your P&L. So I think that's critical. And then the other one, which I'll admit took me a bit longer to understand what it meant than it should have, but this expression, I don't know if you've heard of this, but the 6 foot tall man drowned in the river that was 5 foot average. Has anybody heard that, or is that just me? Yeah, okay. What's the point of that? Well, it's averages, right? Averages hide a lot of things, right? And so it's not good to look at averages. So whenever somebody talks to me about downturn, how do you define that? Is it recession? Is that global? And so I always believe there's local environments, industries, markets, geographies that you need to look at. And so you need to kind of go a lot deeper. And I think that's where we try to focus on fintech. So if I think about fintechs, talking more about the traditional banks, they'll have the benefit of a long history of data. A lot of depth, a lot of breadth. And so what does that mean for us in terms of fintech? Well, I think we can be a lot more nimble. We can be a lot more agile. We can look at other data signals. So I think traditionally there could be a lot of data silos. So it's really hard to make those connection points, really hard to do that mass real-time processing and calculations to make all that better decisions. It might be available, but it's not really readily available for decisioning. And so from a fintech standpoint, we really try to make sure that we're making the most of those data signals and trying to action on that. And actually, I think you mentioned AI. Just one thing, I know there's a lot of
I don't think I did, but go
you
ahead.
didn't? Oh, okay. I thought you were, I've heard AI multiple times today, so maybe that's why I was thinking AI. But, I think talking about kind of the data and AI, it reminds me of the old adage around, execution eats strategy for breakfast. And so I'm kind of likening it now to like data will eat AI for breakfast, and Tom might disagree. He's a world-class modeler, but so I think the key thing is how are you actually using really good, effective data in terms of leveraging the decisioning that you're making.
Absolutely, makes a lot of sense. Brent or Amit, is anything to add from what you're seeing kind of in the market around fintechs, good or bad?
Yeah, sure. I just realized too, the fintech is wearing a suit and the banker's wearing jeans. So I just noticed that. That's funny. Speaking of AI, one thing I've really noticed during like the 2020, 2021, the easy money VC, there was a whole bunch of lenders, especially in the US, that were popping up with, lending solutions with no credit history required, no credit checks. And they were all doing AI or machine learning. I'm not sure what the machine was learning from when you don't have any useful data going into it. But, you're starting to see, I think you're starting to see that reckoning, right? Especially south of the border, like companies like Kettle or Tomo Credit that are now in distress. And I think there's a lot of companies that were born in good credit conditions that haven't gone through a downturn yet. And I think there's still, I think we're just at the start of that. I think there's going to be a big reckoning to come still. And I think you're going to see a lot of those companies either pivoting, so going more from like credit to debit and changing the product, or, selling for scrap or selling for pennies on the dollar. So I think there's going to be a big reckoning to come still from a lot of fintechs.
Yeah, I mean, do work with a lot of fintechs, even though I've been in a bank my entire career. And, what Brent said is the right one. There are fintechs with a value prop, which will definitely do well over the cycle. But, if there are folks but you have to be a missionary to be able to do it. If someone is just a mercenary out to, make a quick buck, that's not something that can survive. The easy money is gone. But there's still smart money there, and there is, it's possible to still, as long as the value prop is right, the execution is right, absolutely, there is still, a lot of value to be created for clients and for shareholders as we look into the space more deeply.
Yeah, it makes sense. And thinking back to a little bit the experience that you were sharing from that kind of 08, 09 time, what are you kind of using from those learnings around, staying open, still investing, kind of trying to time, but obviously not being able to exactly. And kind of how are you taking that to RBC right now and helping to kind of manage that uncertainty that you're seeing?
Yeah, so I think the first piece is, continue to invest in data and technology, right? So it is, yes, we have at RBC as we, are very proud of the fact that we have the largest database in Canada after the federal government, right? So that's amazing having that level of data, but it still has gaps, and it still is are spaces where we're trying to make it more usable, make it more connected, and that's absolutely our spaces in which we are happy to work with, the folks who have some IP, who have the right technology to work on. So that is something that we continue to invest very, very heavily on. The modeling side, we obviously try to own more of it in-house. We're obviously very, very happy to listen and learn. And yes, the intent is, as I always joke about, combining artificial intelligence with real intelligence. But that's is what we are trying to achieve to large extent. There's still going to be some supervised machine learning that we'll continue to focus on, but we also are investing in the right folks. So yes, it's an open call. If there are good resumes out there, we are hiring.
Ardalan, what about you on that?
Brent, I was actually going to ask, I enjoyed reading one of your blogs on Payson, and by the way, he did not pay me to plug him in, but obviously as someone who has a lot of experience in credit space, I remember reading your kind of the lead and lag effect between the business cycle and the credit cycle. I don't know if you want to share a bit about that.
Yeah, no, for sure. And I kind of alluded to that before. I think that, getting in early, the best time to lend is near the tail end of a downturn, right? When trying to catch that inflection point, and people are always too lagged. And so, because then you can get in when everyone else is pulled back and there's a lot of good business. And then, right now, arguably is probably not the best time for lending, because if you believe we're heading into a downturn like I do. I don't think it'll be a severe one necessarily, but that's when you're going to get the most adverse selection. And at the tail end of a bull cycle, that's when there's a lot of easy credit already out there, and people have been striving to hit growth targets. And so, I think it is sort of a bit of a contrarian thing, but the lead effect is really important. The other advice I would have is you can never perfectly time it, but I think the thing is two things is, how do you monitor for it? So how do you create that canary in a coal mine monitoring systems that you're able to pick up on downturn at the first sense of it? And then second, how do you have your action plans pre-baked, so you're not scrambling to put strategies together and get technology built for it? So I know one of the banks is kind of part of their downturn readiness is that they've already got credit policies built and kind of ready to switch on, right? And I think so. The more you'll never be able to time it perfectly, but it's all about being able to move fast, because huge first mover's advantage, right?
On that, Brent, do you have an example of monitoring where you found a canary in the coal mine that kind of helped you throughout your career, or you've been around for it?
Well, one we did a couple, I don't know if Tom or any of the people in the audience here would remember it, but I think when we were really worried about housing prices and consumer indebtedness, kind of in that 2012, 2013 era, we put together a holistic one, like a bull bear report. We called it, where we weren't just looking at our own data, but we're really looking at a bunch of macroeconomic data sources, a bunch of bureau data sources, and trying to create that full picture of the consumer's kind of balance sheet. And I think that's important. I think unemployment rate's one of the biggest things. I think like people can manage debt as long as they're employed. I think if unemployment suddenly spikes, that's typically the kind of match on the, you get all the analogies. I don't know, Ardalan. Match on the newspapers or whatever.
But actually, Sam, and I wasn't trying to defer your question, so kind of, going back around the data pieces, I think there's just some fundamental first principles credit risk management that applies in no matter the environment and the situation. And so, thinking about historically, the gold standard in terms of low risk has been people going into the branch face to face, much lower risk associated with that. And I think, we're trying to kind of turn it on its head in the sense that we get so much rich digital signals being a digital player. So going back to kind of the fintech uniqueness aspect of it, it's around how do we take better advantage of all the data signals that are out there. And so can you imagine, just to throw some examples around the information that's there from a device standpoint. Now that also requires obviously a lot of transparency from a privacy standpoint, from a consent standpoint. So you want to make sure that you've got those fundamentals right. But now you're able to adjudicate risk much better. It's going to turn out to be better both for the organization as well as the clients in terms of the rates, the approvals, all of those aspects that they get as well. And so there's a lot of rich data that is available out there that we're trying to leverage and identify the good, strong predictors.
Yeah, makes sense. An edge on the underwriting for sure. And so I guess then has FIG pulled back currently, like in your underwriting, or are you kind of par for the course right now?
Yeah,
you'll have to kill her if you tell her.
it reminds me back of the opening. I think there's a lot of frenemies here, so that's why I'm hesitating to actually share some of the specific digital signals that we look at. But if anyone's interested, we can talk afterwards. But I think we're always. I think it's just a continuous cycle, right? It's going back to what I mentioned around being nimble. The beauty of it is how can you respond quickly? So we're always pulling back in some circles and going deeper in other circles because I think we're in the business of taking risks that we understand. And so that means sometimes it's a bigger risk to pull back in terms of foregone revenue, right? The opportunities that you're giving up actually cost you more than the losses would, right? And so that's why you want to make sure that you're always kind of trying to keep a pulse on what you believe to be the P&L. And so I would say we're always continuously trying to
and then information too, like your foregoing data. Any other comments on managing uncertainty? If not, I'll go to my next question.
Yeah, I think it is in the data at the end of the day. I would continue to believe in that, and yes, it's more a question of yes, there's this conventional credit bureau data that everybody has access to, and then there's a way you can either get access to data like payment data, or you could or you could figure out new ways of using existing data. That is something which is very critical, but that's something as common example as interest rates went up and folks were renewing their mortgages, their payment spiked, right? And in that environment, is bureau data useful? Absolutely. You still have to use it. But there is, there's a lot that changes between a client who has had a, payment jump versus the client who does not. And then you have to look at that person's, cash flows and payment history and income history to make a better assessment of what would happen going forward. So yeah, absolutely, never underinvest in data in good times because that is what will help in not so good times. And yes, there are signals from a lot of other things, device data, a lot of other data sources out there, but there is some value to that, that conventional transactional payment income data that is there. So yes, I know a lot of times folks want to originate more clients and ask for less data on the applications, keep it simple, keep it easy, but you just have to find that right balance between not asking for too much data to put off a potential prospect or an applicant, but still remembering that data will be helpful later on.
Yeah, going back a little bit to what Brent was sharing around not asking for credit bureau information. All right, any questions from the audience? I guess this is technically a workshop. Okay. All right, so given that you have all been or are currently chief credit risk officers, if someone was saying, I'm starting out my career today, like it's my new role, what would be your advice for that person?
I'll start. I mean, I fell into credit risk kind of midway in my career, and when I was doing my MBA, this was never the sexy topic that would come up. That risk management, who wants to go in there? But I absolutely love it. So I think I would encourage them to say, I think it's such a wonderful mix of both quantitative analytics as well as layering on the qualitative strategic standpoint as well, because you're looking backwards in terms of leveraging retrospective data, but also layering on your expectations for the future, where you want to place your bets, how you want to kind of value certain things. And so I think it's been a wonderful experience. So I think, the general theme is to learn, and I've been fortunate to learn from some great folks. Actually, it's quite an honor for me to sit beside Amit and Brent, because they've both at some point I've worked with both of them and learned a great deal from them. So I think it's just continuing to learn and plan for the long term in terms of everything. It's funny how you end up using certain things that you don't expect, and so it's just paying attention to and moving forward.
Thank you.
Yeah. Well, I'll say, three things, right? The first thing is stay curious. That's really important. Like, world is changing, and, like sometimes, we in banks, by the way, frankly, right? We just look internally. We don't even look at other banks and forget that, at the end of the day, Canada is a very small part of the world. There's a lot of innovation that happens in other parts of the world, and staying curious about it is very important. The second piece is, being very nimble and agile, and that's easier said than done. We all get set into ways. I am sure I have certain places where I'm getting into a set way of thinking, and it's very, very important to stay adaptable because technology does change. AI did not exist 20 years ago when I started my career, and we can't even fathom what will be out there 20 years from now. So if you're starting your career now, just have that in mind. The third is, frankly, in the credit space, it's just too easy to sit at your desk and do your own stuff. And it's, folks forget that, that a lot of learning in this space comes from talking to others. There's always, smart people around, whether they're older, whether they're younger, right? It goes both ways. Like Ardalan, I don't know what you learned from me, but I've learned a lot from you, right? The way you approach problems, the way you think. So that is, something which is very important, like in ensuring that, that you're not just sitting at your desk, crunching data. It's too easy. Just be out there and talk to others in the space. There's a lot of learnings around. Brent?
Yeah, no, my answer is very similar to Amit's. I mean, when I think of being a credit risk professional, I don't think of it so much as a discipline as like a way of thinking, really. And it's really like the scientific approach, right? Like, how do you create a hypothesis, and then how do you create experiments or tests to prove or disprove that, and leverage the data, and learn and continuously optimize. You're talking about, it's not about necessarily pulling back, but it's constantly learning and optimizing and testing and iterating. And I find that really exciting. And I think, that's always been the most interesting thing about being in credit to me, right? Is kind of that growth mindset and continuously learning, right?
So no regrets. It seems like we're making a push for credit. I don't know if there are any credit professionals in here. I don't know if that was relevant to anybody. All right, so I don't have a clock, but we are approaching the kind of end of this panel. Are there any questions from the audience? Yeah.
I just have a question on your market indicators. Some of them are easy to quantify, but when you look at government information,
Yeah.
say like your inflators, your job numbers, and GDP growth,
Yep.
some may say we're on a house of cards, and that may not be, the way they're reporting it may not be real numbers. How do you filter through that data to actually make sense compared to your other ones? That's kind of hard data for credit cards.
Yeah, that's fair. All of the numbers up here, like on the left, are a stats can. And to be fair, we had to kind of cut it short because of the space on the slide, and so it doesn't, to your point, tell the full story.
No, what I'm saying is credit card debt you get from the credit card companies, so.
Yeah, from the bureaus. Yeah.
But the stuff that comes from the government, the way they're reporting job numbers, the GDP growth based on immigration, consumerism, like there seems to be a little bit of a house of cards in our economy right now. Or at least I think so, on the credit side.
Right.
How do you kind of get through that information to get to a comfort level when you're risking a book?
Yeah.
Because like you said, everything's good until someone doesn't have a job.
Right.
Are those real job numbers when the majority of job growth is in
Yeah, and there's still a lot of stabilization coming post-COVID, right? Like that obviously skewed like a whipsaw, right? A lot of it. So I don't know if I have an easy answer for you, but like trying to dig in and really trying to figure out what's going on in the labor market. I think labor market is the most important thing, especially in kind of more of the Main Street jobs. Like you see there's a lot of layoffs in the tech sector, but that didn't really have, it was kind of like a drop in the bucket in terms of overall unemployment. But if it becomes widespread like it did back in 2009, then I think we're going to be headed for a severe downturn, right?
Yeah, I think the key pieces, right? Like obviously I won't comment on the validity of government data or not, but in general, right? Like any data can get corrupted and what have you. So it's very important not to make all your decisions based on just one set of data, right? Like you kind of diversify your risk by saying that, okay, information on bureaus, I have information on income payments, which we verify. We have information from the government. We have information from different sectors of the economy. There are different industry reports. It's like you can't make your decisions based on just one source of data. Otherwise, yes, you are absolutely set up for a problem. Like if either the technology fails or the source of data gets corrupted for whatever reason. So yeah, I think that's what at least we try to do within our space, and we advise people to do is to stay diversified. Like use multiple sources of information and not a single source of information. Ardalan, I don't know if you have a perspective.
No, I mean, I think it's a good point. It goes back to my terrible analogy of the 6-foot person drowning. It's about averages, right? So employment rates might look better, but is it because it's shifting to more gig work or other things that still get reported as employment, but it's not quite as good, right? And what are you ultimately trying to do with getting informed in that data? Or if we look at, oil prices are going down, which geographies is that going to impact potentially in the future? Is that a leading indicator? Is that a lagging indicator? And so I think it's just being able to distill deeper into the more granular aspects that might impact the portfolio, whatever you're looking at. Is it front book in terms of acquisitions? Is it account management in terms of existing book? And, what are the levers that you have? So I think, a lot of times we'll have kind of deeper discussions around which aspects we want to respond to and which one. And again, I'll go back to Warren Buffett where he said, emotions sometimes are your worst enemies. And so sometimes the best thing is actually not to do anything. And so, in what cases do you want to do that? And I think the time for the change is probably the worst time to decide those things. And so you want to do it ahead of time. And so I think if there's one thing to walk away is to be prepared for that downturn now in terms of how you will respond to some of these data so that you're not doing it on the time when it becomes a lot more late, in my opinion.
Yeah, go ahead.
In terms of looking forward, and not necessarily in terms of credit downturns, but there's two populations that I'm curious about in terms of how you determine credit risk. The first one is maybe we should have thought of this before, which is the newcomers, particularly in Canada, which still seems to be unsolved. And the second for credit is our boomers who are all retiring but may still want credit. And so, have you thought about that and how you might?
I can start only because I'm in a big bank, right? We cater to every segment. So I, before my current role, actually owned the newcomer strategy for RBC, right? So I actually have on the newcomer side, I can tell folks with confidence that newcomers is a great segment, right? Anytime we have expanded our credit appetite in that space, it has always been more profitable. Now, obviously everything has its limit, so you can't just keep on doing it. But absolutely, what we have realized is that that's a space in which, at least so far, up to a certain limit, more has been better on average. Now, you have to be careful. Newcomer is not a single segment. Ardalan, you do have a very good analogy. I won't repeat it, but yeah, that's the important thing to remember, that you have to make it more granular, what source country we are talking about, which is it permanent resident versus student? What if you're talking about students, now you're talking about grad course versus undergrad courses, a whole bunch of these areas that we look at least within the bank when we think about newcomers. It's not two newcomers are not the same, that they could be very, very different. So that's newcomer piece. On the other side of it, yeah, absolutely. Like everybody has, has banking needs. They just evolve. Even on the credit side, someone who's on the boomer side, like, will definitely have, on the, will definitely have, you know, need, like, now people have equity in the home that they want to use up, during their lifetime. They just need the right products to be able to do it. But we also have a responsibility to keep clients safe, right? Like, the last thing we'd want to do is do something, that then, like, ends up harming, like, clients, especially folks who are the most vulnerable. And that's where we continue to struggle, right? Like, what might be optimized might not be conservative. So how do you keep that, right balance between the two is what we don't have, like, perfect answer for, but we try to get, better over time as we have more information. And again, we try to treat, folks in that segment, very differently based on, what might be, a lot of their demographic and other attributes. But absolutely, there's more to be done in that space, both of those spaces. But I do want folks to also know that more is being done. Like, gradually we are getting better in that space. When I came to this country 16 years ago, I had to get a, secured credit card. The concept of an unsecured credit card did not exist. And the first things which I'm very proud of was, like, I was actually approving, like, at least RBC's credit strategy, which offered unsecured credit cards back in the day. So things are getting better. And we also have to be careful, right? Like, a lot of times, like, like, folks come and, they have a very US-based mindset. Like, like, US newcomers have bigger issues. And a lot of times, like, especially, like, organizations which are more US-centric, they come to us and they make these statements that, that, yeah, newcomers don't get credit in Canada. That's not true. Every bank, and, like, a lot of even non-banks offer, unsecured credit cards as an example to newcomers. And that helps newcomers build their credit history, very, very quickly. So again, I just want to be careful that, that we are doing much more in this space, but we're not perfect. Let me also, be very conscious of admitting that. Brent?
We're quite close on time, so I'll just move to closing remarks. I'll give you guys 30 seconds.
No, I mean, I think, not a lot more to add, but maybe I'll just use the time to say, the responsibility really resonates with me. And I think we've noticed, a concerning trend around fraud. And I know this wasn't a topic on fraud, but just the level of investment scams and how they're targeted, especially in particular boomers as well. And so, I think as good corporate citizens, good Canadians here, good for our country, we want to make sure that we're doing the right thing by them, not just in terms of extending credit to the amount that they can afford. That's certainly a big aspect of it from a credit side, but we're focused on working with organizations in terms of stemming some of this concerning trend around scams that we've noticed, that it's really eating into all the investments that retirees have. And then coming in at our stage, we see it when they're coming in for a loan beyond that. And we're able to help the customer in terms of identifying, hey, this seems concerning. You might want to take a second look here. So, that's kind of what I wanted to close, which is, at the end of the day, we want to make sure we're doing good for across Canadians. And we have a lot of responsibility in terms of the decisions that we make, because credit is so important for the general populace. So we take that seriously.
Thank you.
Yeah, like, I would say, like, ultimately we all have to come together and, make sure that as we make decisions within our individual organizations, that collectively we are also making the right decision for our country. At the end of the day, we'll all do well if the country does well. We will not do well if Canada does not do well. And that's the accountability that, that all of us in this room have, that as we build our models and strategies, we do, should we compete? Absolutely, we should compete. But there are segments, whether it is fraud, whether there are, collections, whether there are other areas where we do have to come together and make sure that, that we are making the right decisions for the country overall.
Yeah, and one thing I'd end on, Amit and Ardalan, you guys kind of touched on this too. There's, like, behind every credit decision, there's a human being, there's a person behind there too, right? And we always talk in the risk business, we often talk about willingness to pay versus ability to pay, and which is it? And I think what I learned going through COVID was this global experiment really proved that it is, for the most part, an ability to pay. Like, beings want to fulfill the debt obligations, and they want to leverage credit to do something better with their lives. And if given the opportunity, they will pay back. So we saw that was the same. By the way, we work across the globe in every country that had substantial government benefits saw like a 35-40% decrease in credit card delinquencies once the government subsidies started rolling in. So I think people do really want to repay their debt. And so as you're heading into downturn, think about that human element as well, what you can do from a hardship perspective and how you can help, put people on hardship offers that need it.
Amazing. Thank you all so much. Thanks, everyone.